Morning, but our next guest says the seasonals paved the way for a strong setup from here. Joining me now, Renaissance Macro Research Chairman and Head of Technical Research, Jeff deGraaf. Jeff, it's good to see you. I know you've been in a mode for a while here of, open your mind to what might be able to go right in the markets based on depressed sentiment and some of the other action in terms of the character of the rally off the lows. Bring us up to date with that. Where does it stand?
Yeah, thanks for having me, Mike. Well, look, I think you had a couple things that kind of changed the narrative here. I mean, one is this massive expansion in momentum, which is good news. The rally was led by beta. That's nothing new. Almost every rally off of some significant low is led by beta. So there's no real characteristic change there. But we did see this, surge in some of the new high data, some of the breadth that we look at. These things are usually typical of a low that's been set and will be, a hard one to breach for some time. So I think we're in really good shape from that perspective. And I think the trends will start to change and improve, though they tend to be a little slower. The real thing for us, bringing up to speed, I think that we're going to move away from beta. And that's what we've been suggesting for clients is not that beta is going to be bad, but I just think the delta, the surge that you had in beta is probably, probably 80% through its normal course of action. And now what we're really looking for is relative strength and momentum. Those are the things that you want to be owning right here, because the narratives might not be clear, but they sow the seeds. They're kind of the germinating leadership that's going to be driving the narratives as we get into the back half of the year. So our real call here is less about a market call, even though we think it's bullish, is really transitioning from the beta-centric call into something that's momentum-based, relative performance-based, because those are going to be leadership names as we go.
Right. So not necessarily, in your view, an environment to go kind of hunting for laggards and turnaround type candidates, I guess. I
think that's actually one of the worst things you could do right now, to be honest with you. That's historically not the place you want to be. Yep.
Yeah. In terms of maybe what could get in the way or present a hurdle here, where does the stock bond, treasury yield dynamic play right now? We've been kind of here before, not that long ago. It's not as if yields have broken out, but it seems like there's some sensitivity to higher levels.
Yeah, I totally agree with that. I think the one thing that we're looking at that we feel like could disrupt our call is where bonds are. Now, that's becoming a little bit more consensus, so we feel a little bit better about that. If everybody's concerned about it, it's probably not much of a concern. But, we've got models that we look at relative value of bonds versus stocks. And, in fact, our asset allocation model is pretty heavily weighted for bonds here, given our relatively bullish condition on the S&P. And that's because there is value that we see in the bond market right here. I feel like it's the villagers have gathered. They haven't sharpened the pitchforks and they haven't lit the torches yet, but certainly they're stewing and they're ready to go. So those bond vigilantes are out there. We'd start worrying about that over 4.75 on the 10-year. But look, the 30-year yield looks like it's in an uptrend. If it was, if it had the symbol Google on it, I'd tell you to buy it for sure. Yeah, right. The 10-year yields is still in a range. Basically it's 4.20 on the downside to 4.75 on the upside. So the good news is we're still in that range. And then you look at the 10-year, the short end of the curve, and it's continued to be in this downtrend. So it's really a tale of three different bond markets, if you will, depending on the duration. So it is something we're concerned about. We're not seeing it in corporate credit. We're not seeing it in some of the liquidity measures that are out there and some of the other factors that we look at. So I've got some solace with that, but I do think it is a potential disruptor in the summer.